All right, all right. So this is looking at the communication services sector, and I don't know what happened with my data, but we do know that AT&T is the sector leading MVP. I'm almost afraid to refresh here. I don't know why it. Okay, there we go. All right, so AT&T sector leading MVP. So we're definitely going to look at that one. OMC, we've seen that one a few times in some of the better performing portfolios. And then IPG sector leading as far as performance. And then Rogers Communication is where we are. So again, we do have a sales signal on it. And even though it's not, sector leading MVP or even um, uh, better performer, we're still going to look at potentially keeping it just because we're already there, right? So let's take a look now at these companies. Right away, um, we see that AT&T just is double basically the dividend of the rest of these guys. That's been the case for a very long time. AT&T has always had a really high dividend, and I'll definitely want to look at the financials of the company to make sure that that dividend is in place and not going to go anywhere anytime soon before putting any money into the company. All right, PE ratio. AT&T has the lowest PE ratio, and again, that says a lot about where the stock price is. It's not doing very well at all. Well, not saying it's the worst performing company in the sector, so that's the reason why the PE ratio is so low. But with that being said, IPG is 13, almost 14, and then OMC is very close to that. Rogers is actually one of the highest, along with Telus, and so again, it just goes to where the stock price is. Right now, Rogers Communication is pretty much at its 52-week high as far as current price. So that means that if we sell here, we'll be selling high. Buy low, sell high, right? All right. Um, 5-year average though, it looks like Rogers is nowhere near its highest mark. The rest of these guys are fairly close, with the exception of AT&T. And I guess you could say that same thing of, well, no, you can say the same thing of IPG and OMC as well. So I think that says a lot about the sector itself. Telus is the only one that's really closest to its uh, 5-year high. And so that means that all these guys are really not doing as well as they have done over the past 5 years. And then looking at their average low, um, most of these guys are closer to their low, other than it looks like Rogers and Tullis. And so what that means is that OMC and IPG um, pretty much up from here, right? Unless something drastically happens with the business, then all we can see is up. Versus Rogers, which even though it's far from its high, um, it's as far from its low, so it's right in the middle. And then Tullis is closer to its high, meaning that more than likely we'll see the price come down before we see it go up. Um, with that being said, I'll definitely want to look into why I'm sorry, IPG and OMC is closer to their lows than their highs, because maybe there's something going on with the business that we'll need to take a look at before getting into the business. All right, so on average, looks like OMC is close. Yeah, yeah. OMC, Rogers, and Tullis are all at their average. Looks like IPG is far from its average. So again, um, that just cautions me to say, well, is this a company that we can buy really cheap, or is it a company that has some structural issues that will want to keep us away from it? And we see that reflected here in in the the difference. 48% really large, and then AT&T um, even larger. And we can't say a whole lot about AT&T here. I've said it before, you can't have a negative PE, but this just means that at some point AT&T was losing money. But the company has really made something of a transformation over the last couple of years, getting rid of DirecTV and Dish and all this kind of stuff. So can't really make any um, generalizations just based on these numbers, but we definitely can when looking at IPG um, compared to OMC and Rogers, um, which again, these guys are way off their average, and Telus is way over its average. And so that just lets me know that Telus is at the near highest peak of its price range. So if we were to purchase Telus here, we'll be purchasing it high instead of buying low and selling high. We'll be buying high. It doesn't necessarily mean that the price can't keep going higher. It just means that the risk is that the price will go lower. And so again, we'll want to see what's going on with IPG and why the stock price is so low. All right, net profit. Going to be really hard to compare IPG with the rest of these guys, but the rest of them we can definitely compare. And it looks like Rogers and AT&T are making the most money. Well, you can put Telus in there too, um, and so that looks really good. Return on assets. All these guys are in the same vein there. All right, so looking at cash now, remember this is going towards um, the M score that we talked about, right? We know that the M score companies are performing the best, and as we see, IPG has the best by far. I mean, blowing the rest of these guys out of the water as far as cash on the books. Now, again, it's really hard to compare IPG with the rest of these guys because IPG is not a phone company, right? Um, so there may be an unfair comparison, but still, we have to look at what their M score is compared with the rest of the market. We'll be able to do that here in a moment. All right, cash to debt. So this is how much cash they have versus debt. And so typically, the higher the number, the better. And so we see that again, IPG is kind of at the top there, followed by OMC. So um, comparing strictly phone companies, we'll say that OMC really has the better M score out of the rest of the phone companies. Okay, IPG may have a better M score um, compared with the rest of the market, but we'll take a look at that and see. They definitely have a better score concerning debt, and so that's really good to see. Um, Here's an issue though, the short interest. The short interest is really high in OMC. This is the highest short interest I think I've seen in the past year looking at these companies. Same for IPG. And I've said before, I'll say it again, short interest simply means that there are a lot of people betting against this stock. And so the question becomes, do these people know something that we don't, right? Why do they think this stock price will lose money? Also, the other thing with short interest is it may be very hard for the stock price to move up if there's so many people willing to bet money on the stock price moving down. Meaning that as the stock price goes up, the people who are betting on it going down are probably going to throw more money at it, right? Because they know they're like, this thing is going up. There's no way it should be going up. So they'll put more money at it, pushing the price level down. And so that is a bit concerning. And again, we'll really want to see why OMC and IPG have this short interest that they do. Again, this is looking at where the price is relative to its high. As we can see, everyone is pretty much, other than Rogers, um, uh, kind of off of their highs. Telus, we've already talked about, is off its highs. But compared to what we saw as far as PE ratio goes, it appears that Rogers is cheaper based on PE ratio than Telus is relative to where the price is compared to its high, right? So Rogers is definitely closest to its high, but cheaper than Telus. Uh, AT&T, again, just horrible performance, way off its highs at 32%, and then OMC and IPG pretty much right around the same. All these guys are going to be at the same distance from their absolute low, other than AT&T. AT&T is at its almost absolute low, meaning that either it's going to continue lower or it can only go up from here, right? But I don't know. Again, we'll have to look into that and see where it goes. But based on some of the other factors we've seen so far, I don't know if AT&T is going to be our pick. All right, so Alpha, these are companies that perform well when the market is performing well. We do know based on the last 12 months that it is important to have some of this alpha in return in the portfolio because we definitely can't do a strictly beta type portfolio, even though the M score, which is still something of a defensive portfolio, is working well. So the largest number wins. These are all negative numbers. So Telus is the better performing alpha score, followed by AT&T and then Rogers. IPG and OMC are at the bottom, which I think says quite a bit. Um, let's look at the up moves now. The higher score wins. AT&T, when there's a lot of money going into this thing, the price tends to move up versus down. The worst performing is Rogers. Um, and then so the down moves, which is the portfolio that we have been following this year, Rogers is leading um, the the pack in this metric. But we do know the market has changed. Down moves are no longer where it's at. And so this metric really is not going to say much at all because down move portfolio is just not working well. All right, beta. Again, the higher number wins. And so IPG, for whatever reason, performs really well when the market is performing poorly. Go figure. And so that may have something to do with the short interest as well, because what happens is if you're betting on the stock price to go down when the rest of the market is going down, IPG is probably going down as well, but you have persons who have bet on IPG to go down who are going to cover their positions, meaning that when you're betting on a stock to go down, you're in effect selling the stock first, right? And you're going to sell the stock, and then as the stock price moves down, right, then you're going to purchase the stock so that you can make profit. And so what may be happening is that all these people are betting on this stock to move down. And so when the rest of the market moves down, typically all these companies are going to move down with the rest of the market, right? But IPG has all this short interest. And so when we do see the market down and this price down, people are purchasing the stock to make profit on their short positions. And maybe that's why we see IPG performing a bit better than the rest of these guys. So OMC, same thing, even though the short interest is higher in OMC. No, I'm sorry. I think the short interest was higher in IPG. Anyway, the point is, I imagine that's kind of what's going on there. All right. And then the 1 month return, we do know that IPG beats out the rest of the sector over the last 12 months. This particular metric is based on the last 3 years, with this year not being a factor. Okay, and the reason why it's important that we do that is because we don't want recent events to taint or tarnish our metrics. We want to see what the long-term effect has been and not what's going on right now. Okay, so that's the difference. Now we know the last 12 months, IPG has been the better performer. But like I said, long term, over a 3-year period, not counting this year, Telus is actually the better performer, which is what I think second best right now, right? So um, it makes sense, you know. Followed by Rogers and then AT&T. So um, I don't know what that says, but I think long term this means that Telus performs better. Um, but again, Telus is also at the top. So again, purchasing Telus here means buying it at the top. So that's something that we'll have to look at. All right, volatility. We did see the standard deviation portfolio is performing best. And so when we see volatility really high, that means that the stock price moves around a lot. And so in situations like this, we want companies that don't move around a whole lot. And so Telus wins in that regard, followed by Rogers Communication. IPG moves around a lot. Again, really hard to compare with the rest of the phone companies that look like they're about all the same, right? Okay, score. Um, Again, we're following the down portfolio, and so AT&T and IPG are basically tied. And because AT&T is a sector leading MVP, I have to imagine, wow, let's pull this out further and see if we can, nope. Now, I did purposely do some math here to get these things to not equal each other. That's really important. But in reality, it's an arbitrary number, not a real. I'm just trying to see where the, my goodness. All right, well, um, how many decimal places did I carry this thing out to? 1216. There's no way. Okay. Well, I don't know. I can't, I don't know. I know that I did some math to make sure that these things never equal each other. Otherwise, the program would never be able to pick a number one or number two. Um, so uh-oh. So how that happened here, I don't know. Um, but we do know that AT&T is the number one pick for the down portfolio, and based on this, IPG comes in second. So I think that says something. And then again, M score, OMC, uh, first place, and we talked about the cash and cash to debt, and so we see that OMC just blows really everyone out of the water when you're looking at the M score because it takes into account not only cash but also debt, return on assets, and all those things. And M score, by the way, means management score, which is basically how well is this company being managed from a financial perspective. And being that we saw, so much um, as far as the M score um, beating out the rest of the market, really going to have to take a look at OMC here. The only issue that I'm concerned with again is the short interest, and so that means doing some real digging to figure out again what that short interest is about. Um, what, if anything, is out there that isn't surface level information, which can be hard to come by. Maybe it's lawsuits, who knows? But point is, some digging is necessary. Um, regardless of any of that, I do think that it is prudent for us to exit our Rogers position because um, even though even though it is um, even though it is performing well now, it has languished for quite some time. It really has. And um, so getting into something new, I think will be a good move for us. I do have to say though that the current sales signal for Rogers Communication is based on March 2nd data, and it's currently March 15th. And so the stock price has fallen a bit on Rogers. And so if we were to sell out of this position, we'll have to wait for that stock price to move back up before making any changes. But again, we'll look at OMC and just for fun, we'll look into IPG as well as possible replacements for our Rogers position.